If you're approaching retirement or already retired, there's a powerful question that you need to ask yourself. Have I had the right conversations about retirement, or were they just investment conversations? Because retirement success is not determined by a single product, a single account, or a single return number. It's determined by the quality of decisions that you make across your lifetime. And those decisions start with having the right discussions. So today, we're going to walk through the 10 most valuable retirement conversations, the ones that separate retirees who feel confident and in control of their life without constant financial stress.
All right. Well, welcome to Unlock Your Retirement with our host, Bruce Smith. I'm your co host, Tony Shore. Bruce, that sounds great. We've got a great topic for the listeners and viewers out there. You always manage to come up with really timely and important topics, and this sounds like a great one. A lot of stuff you need to know. So before we get going, why don't you let our listeners know how they can get a hold of you if they have questions about what they hear on today's show or want to set up that no charge, no obligation consultation with you and your team there?
Well, we always say it starts with a conversation, and today's show's all about conversations. But
Yeah.
to have we call it our 20-minute discovery call. It's a conversation with one of our lead advisors, myself, my son Bruce, Chris, whoever. And you give us a call at Tony's favorite number. No matter how many radio shows he does, 10 years from now, 20 years from now, we're going to go, the favorite number of mine, 888-888-5601, so.
I hope I don't sound like that.
Yeah, well, I
Maybe
don't
in
know.
10 years. I don't
We're
know.
headed down that road, but
Yeah.
888-888-5601 or discoverunlock.com for your complimentary 20-minute discovery call. No sales talk, no pressure, no nothing, but it's really about the elite wealth planning process that we use here at WealthCare to help you unlock additional massive value that you may not be enjoying from your retirement planning currently. So give us a call, hit the Discover Unlock, and we've built in something new. We talked about it last week. When you go to Discover Unlock, one of the things that a lot of people or a lot of our listeners have talked about over the last couple of years was everybody likes a checklist because everybody's so busy. You know what I mean? And so you will actually get. We have so when you go to Discover Unlock, there's a quick 5-minute self-assessment that we let you do, and at the end of that, you will get immediately in your email a strategy comparison of basically things that you want to have in your retirement versus maybe what you're doing or not doing. And that's without ever talking to us. So you get that for free. Just go to discoverunlock.com for your complimentary strategy kit as part of scheduling a 20-minute discovery call with us. And we'd love a chance to talk to you.
Well, yeah, I think that's a great offer for our listeners out there. And you make it so easy with discoverunlock.com. It'll walk you through the steps to get that set up. And again, there's no charge, there's no obligation. If you have $500,000 or more saved for retirement, you're going to want a solid plan and advanced strategies to make sure you're minimizing that tax burden, make sure you're not going to make costly or expensive mistakes. Or if you just have questions about what you hear about on the show today, check it out. And Bruce and the team there at WealthCare will help you out. Now, Bruce, a great topic today. We're talking about some of the most valuable retirement conversations and conversations that can help you determine how long your money will last. That's an even better deal. Where do you want to start? What's the first conversation you want to touch on?
Well, I think you hit the number one we get is no matter how much money you've saved, it seems like the number that everybody's concerned about is, how, will I have enough income to support me in my lifetime? And I don't want to run out of money. And I think more than ever, we have a lot of things facing us that can cause that event of running out of money to occur with obviously, inflation, unforeseen medical expenses, long-term care issues. I mean, just more and more things on the horizon. But the important thing is that, it should be about a conversation. This whole show was really predicated. Recently, I had a client that came from another firm, and we were having our discussion in a live meeting, and they said, I said, the thing we love about what we've done with you is, he said, we called, we had our discovery call on the phone with you, the 20-minute call. We came in for an appointment. We had a great discussion. And they said, you never drop products in front of us. Too often it's not a conversation. It's a, you listen to me. I've got a product for you, and people, they don't want that. They don't deserve that. That's not the right way to go about it. If you want to maximize your wealth, it's got to be a give and take. We've got to know about you, know about your situation so we can custom plan. But I think without question, the number one conversation is it needs to be, all right, why did I do this? Why did I save all this money? What do I have enough money to provide a stable income stream, a sustainable income in retirement? That's the number one conversation. There's a lot of pieces to that.
Yeah. Oh, there are so many moving parts, and that's where you come in. That's why you have to be working with a trusted financial services professional like yourself, Bruce. So, that's what everybody wants to know. Is my money going to last as long as I do? How much can I spend every month for life? Do I have enough? These are the big questions, the conversations that people are having. And, a lot of them never get clear answers on these things.
No, a lot of times they don't get a chance to talk. That's one thing that we have really prided ourselves when we launched Wealth Care in 1996. One thing that I always hated, because I did sit in on other appointments with other advisors, and when I was vice chairman of Investors Capital, we did spot checks, things like that. And you would find that a broker would talk directly to one person if there was a couple there, and they wouldn't talk to the other person. And it's like, we bring the spouse into the conversation because this is an important question, not just for lifestyle when they're both here, but the lifestyle that exists after one of them passes. We deal with the hard questions, but we get if you're going to build a plan, you want to plan for eventualities, and income is certainly a big one.
Well, yeah, it's probably the biggest concern that pre-retirees have and retirees, and I like to say you don't want your bank account to hit zero before your blood pressure does. I have to work that in every conversation because that's the biggest fear out there, right?
Hold on, Bruce. Here comes the blood pressure one again.
I'll be using that 10 years from now too.
Oh yeah, yeah. God, but we're still going to be having fun.
Oh, of course we will, Bruce. I mean, that's what this is all about, and helping folks, helping our listeners and viewers out there. So you talk about income clarity versus balances, why rules of thumb aren't a plan. The 4% rule isn't a plan. Oh, I've got all my money in a 401k and an IRA, and I'm going to retire and just take 4% out a year from that or a month. That's not a plan, is it?
Oh my God, it's funny when you show that to somebody, they're like, yeah, well, I heard so and so say 4% rule, or Fidelity told me the 4% rule, and I said, okay, let's make this simple. I said, help me along here. I said, and I'm going to let you be the judge of how valid you think this is. So you've saved $1 million in your 401k, and you're going to take out 4%. So 4% a year, that represents $40,000 that you're going to take out. Now, you're not going to be able to take Social Security for another 2 or 3 years, but you want to retire now. I get that. So $40,000. Tell me, does that work for you income wise? And they'll probably go, no. I say, well, hold on. Oh, wait, it's not really $40,000 because you took it out of your 401k. And you're going to be in the 20% tax bracket. So that's $8,000. So we're down to $32,000. And they're going, well, no, wait a second. Hold on, and then, not in Pennsylvania, but if maybe you have state tax. Oh, so we're going to take a little bit more. Okay. Oh, wait a minute. There was some inflation that occurred, so what you planned for is going to be even more costly. So is the 4% rule really works if you talk to Fidelity and Vanguard and all these people? Does it work for you? And they go, no.
Said, okay. Exactly. Exactly.
Because I said, the financial community, the financial universe out there, whether it's insurance companies, banks, brokerages, whatever, they're all about gathering money, getting their fees, and keeping that money in their hands. And,
Right.
whenever you have the hard questions of saying, have we done stress testing for income? Have we ensured our legacy is sufficient? All of these conversations we're going to talk about, they give them just a quick jab of an answer just to fill in space, but it's not
Mhm.
valid. It's certainly not specialized and built for
Right.
your situation. So yeah.
Right. Yeah.
Yep.
Yeah, I think that's a really good point. Now, and this that leads into the next conversation that I hear happening, especially if someone's using the 4% rule, and they're drawing money for to pay, their monthly expenses in retirement out of an account that's 100% in the market, like an IRA or their 401k. What happens if the market drops early into my retirement? What if the first year I retire, we have another 2008 and the market drops 50%
Yeah.
and
This
I'm
well,
taking out 4%?
Well, see that's it. It is an additive process. And we talk about market losses and we always say, like one of the things I talk about in my book, Create Wealth, Retain Wealth, is see your money as a pile of real cash, of dollars. Because all this other complicated financial jargon can just go right out the door. It's a waste of time. Let's keep it simple. Wealthy people want their money kept simple. We keep it simple for you. So if you have that $1 million in your 401k and the market drops 30%, you said 50, I'm not going to be as severe. So 30%, that's $300,000. Now somebody
Mhm.
was taking a 4% rule, they're taking 40 grand out. Okay. So I said, so here's what's happening. That $300,000 is exactly the same thing as you writing a check to a scam artist that cashed your check, took your money, and you got nothing in return but heartache. So I said that's 300,000. Oh, you needed 40, so you took out $340,000 of $1 million that you saved for retirement. You all these years you worked and you saved. You weren't taking withdrawals, you weren't paying taxes, none of that stuff. And so this occurs. What do you have left? You have less you have $660,000 remaining. Now, how hard do you think that 660,000 has to work to still maintain that 40,000 a year? Now you're taking a much larger, you're taking about an 8% withdrawal. So you're burning down the house a lot faster. And why? You didn't change your income. You didn't take more money for anything special. It's because the market took a $300,000 income check in the form of market losses out of your account. So if I say, well, let's adjust it, now it becomes $24,000 a year. So if you had a 30% drop in the market plus the income you took, you're going to take a 40% haircut if you want to have the same ratio of income. This is why risk management is tied in with income, and you're not going to take the same risks and use the same portfolio that brought you to retirement. To get you through retirement, you want to be significantly less risk. You still want the opportunity for growth, and you can combine those with the universe of tools that are out there now to elite wealth planners. A lot of advisors don't have access to a lot of these things. We do. You can have wealth protection and wealth preservation in place for the bulk of your assets and still have good, healthy returns in the up market. And I always say, as that wonderful chicken farmer said to me one time, he said, I don't have to work my money near as hard if I didn't lose it in the first place. That's one of the cornerstones of discussions when we talk about risk. So, but you need an elite wealth advisor that has that larger universe of tools to prevent that from happening and have it wreck your income plan.
Right. So if the market drops, those losses hurt more when you're withdrawing, right? I mean, if what you have in the market can go up and down, that's fine. That's natural. Sometimes if you're putting money in, it's good to have those corrections or down times. However, if you're in retirement and you're taking money out and the market drops, those market losses hurt a lot more if you take money out while it's down because you're buying low, which is the exact opposite of what you want to be doing. And it takes that much more to regain what you've taken out, right?
Yeah, mechanically, this is what it looks like. If you have $100, and I do this with couples all the time. I
Sure.
said, talk about risk. I said, John, you have $100, and let's say that you lose 50%. How much is left? And he says $50. I'm like, okay. I said, Mary, now this is going to be tough because listen closely. You have $50. You invested, it makes 50%. How much do you have? And a lot of times I'll say, oh, I have $100. Say, no, you had $50. You made 50%. You have $75. You have to make 100% return to get back to even. And I said, and there's where the problem is. Now, that's just normal growth and market losses and gains. Now, when you take into it and say, okay, you lost 50%, you have $50, and you take out $5 or $10 for income, how much do you have to make back to get back to even? And it's over 100%. So the probability after a steep market decline in an income scenario, you need the income. You're probably not going to take a downward adjustment on your income. You're like, oh, I need that. That's my lifestyle. Okay, well, all of a sudden you have this spiral effect. It's just burning down the house. So it's very, very important to mitigate risk, put your
Yeah.
portfolio in a good position so that, you're not losing money when the market does tank, but you have good upside potential still to offset that income in most cases.
Sure. And for our listeners out there, how can they do that? How can they ensure that they have the proper plan in place? Let them know, Bruce, how they set up that no charge, no obligation consultation with you.
Yep. So basically, just give us a call at 888-888-5601 or go online to discoverunlock.com. You'll click in there to get your appointment. But right as soon as you click there, they're going to give you a real nice, quick self-assessment you can do, which gives you a free report in your email box. Basically, hey, these are all the things that I should be asking questions, I should be having conversations about. So we give you a checklist for that, and that's inclusive at discoverunlock.com.
Awesome. Well, that's great. Again, that's discoverunlock.com. It's as easy as that. Just go there, get the information you need, set up that consultation. Now, today we're talking about the most valuable retirement conversations that can determine how long your money's going to last. That's a big one. Conversations that are going to shape your retirement outcome. That's for sure. And you've already talked about how much can I spend safely every month for life. That's a biggie. That's where people start. What happens if the market drops early in my retirement? What happens if I want to retire in 2027 and a year from now the markets tank in January of 2027 and I've just quit my job? What happens? Can I have a plan that will adjust for that and take into account that type of situation? And I know that's how you help your clients and the people you work with there at Wealth Care. Let's move on to the next conversation, which is, what will taxes really cost me in retirement? And you already gave an example that does kind of talks about that. The money you have in a traditional 401k and a traditional IRA, those are fully taxable. And a lot of people don't think about that, do they?
Well, first of all, I'm still amazed at the number of people that come in and they tell me it's not taxable.
Right.
In today's world, it's like, okay. So, and this is our approach to it. And this is a question that I put out there to every listener, and it's really very simple. Is the financial industry, first of all, they say we don't provide tax advice, but they told you to open that IRA. They told you to open that 401k, and they even sold you on the premise of tax deferral. Pay taxes later. Don't pay them now. Let your money accumulate. Let yours and Uncle Sam's money grow at the same time. They don't give tax advice, but they sure put you into that direction, right? So you do that. Okay, that's great. And then we say, so you pay taxes later. Now, what I tell people, I said, would you go into a car dealership and there's a beautiful car there on the showroom floor and you kind of go, man, I really would like to have this. And you ask the salesman, how much is it? And he says, oh, it fits you perfectly. It'll be great in your garage. Your wife's going to love that color. This is the softest interior you're ever going to experience. My God, is it fast? It gets 100 miles to the gallon. You go, how much does it cost? Oh, and these are run flat tires if you run over a nail, and they go through all of these benefits, and you go, how much does it cost?
Right.
So, what did the government do many years ago to the car dealers? They made them put window stickers on the cars.
Yep.
You have to, when you walk up to that car, here's how much this car cost. And I said, so under the same premise, you were told all the benefits of tax deferral. I said, has anyone ever shown you the window sticker and said, this is what it's going to cost you over your retirement lifetime, paying taxes at a time that you least want to? We're talked about retirement income, and all of a sudden it's like, wait a second, if I want X income, I've got to take X plus 20 or 25% of money out to get the income I need for my lifestyle, because I got to pay toll to the troll, which is Uncle Sam. So how much is that tax bill? And in today's world, we have the experience, we have the advanced tools,
Mhm.
we have the strategies where we're able to map out what is that tax cost, what is that projected tax cost over your lifetime from now till the date we choose. And we typically run plans out to age 90. And some people say, I'm never going to live that long. I say, but if you do, you don't want to run out of money, do you? Sometimes people will tell us, run it to 100. I'm going to live long. Okay. So what's the tax bill to you over your lifetime? What's the tax bill to your heirs, to your legacy, to your family? How much is Uncle Sam going to get of that? So you go through all of this, and they're like, wait a second. So is there a choice? And I go, yeah, you have a great choice. I said, all you do is this wonderful book. It's called The Tax Code. And it actually tells you all the things that you can do. People think the tax code is a negative. And I'm like, my God, it's like having the other team's playbook.
Right.
It's wonderful. It's like, I've
But
got
Bruce,
this.
people don't want to read it. I mean, let's
No, well,
bottom line
you
that.
don't want to read it. It's huge.
Right.
But we wanna know how, so with our experience and tax, what we found is one of the greatest opportunities for your retirement wealth, one of the greatest conversations is having that tax conversation, because instead of looking only at the investments and it either gains or loses, we say, well, hey, what if we can find the additional quarter million, $500,000 that you don't have to take out of your account and give it to Uncle Sam, because you're going to pay your taxes this way. And we're going to reduce that window sticker by 20, 30, 40% over your lifetime. You get to keep that money. You get to enjoy that money, live that money, hand that money off to your kids, whatever. And this is the one, certainly we get more people saying, Bruce, I don't get that anywhere else. This is something if you're going to unlock your retirement, you really want to focus on, want to know what the tax value is of smart, wise tax planning, using the tax code as your playbook, to your advantage. So you pay your fair share, your legal pay, these are legal strategies by the tax code, but I don't want to unnecessarily overpay. And that's where people, fall short. They didn't have to do it during their lifetime. They were just accumulating. Now, let's minimize the part that goes to the tax man legally. Let's keep more of it what you need. It's probably one of the most important of the conversations you can have. And if you're not having it, you need to give us a call at 888-888-5601 or go to discoverunlock.com, where you can have that conversation and maybe unlock massive additional value that you didn't even know existed. Because if you don't do it, then it's money you're going to forfeit to Uncle Sam unnecessarily that could have been avoided.
Exactly. And we're out of time for this first segment, but we'll be right back with more great conversations after this. Stay tuned and unlock your retirement. We'll be right back. Welcome back to Unlock Your Retirement. I am your co-host, Tony Shore, and I'm here with our host. The man with the plan is Bruce Smith. Bruce, great show so far, talking about the 10 most important conversations regarding retirement, or that people have about retirement or about their investments that will affect their retirement income. And we've talked about a lot of things. We've talked about what happens when the market goes down and I'm in retirement. What happens with taxes in retirement? Do I need to plan for taxes? I'm not going to be working Why should I be paying very much in taxes? I'm going to be in the lowest possible tax bracket, right? You say probably wrong.
Yeah.
If all your money was in a 401k or IRA or tax deferred account, a lot of us have been really enjoying that tax deferment during our working years, which
Yeah.
is ironic because that's when we have the most income and the tax rates have been historically low. So probably that's the time we should have been paying those taxes. In the future, they might go up. We're going to be in retirement 20, 30 years, most of us. So in that 20, 30 years with the debt our government, our nation has at what, 37, 38 trillion, I don't know where it's at. It goes up exponentially every single minute. So taxes have to be increased at some point, I would say. However, you talked to us about that. I think that's a big conversation, and I'm glad you touched on that. What's next? When should I take Social Security? This comes up. I swear Social Security and taxes always come up, but these are the biggest conversations people have and the biggest questions about retirement planning that people have, aren't they?
They're probably the most prominent conversations. They're not necessarily the most valuable conversations. I had an interesting call with a new client this week, and he asked me a question. So these conversations, they can veer in many different directions, and we don't just, we don't have a tunnel vision and only talk about certain things. And he asked me an amazing question. I don't think anybody's ever asked me this in 40 years. He said, Bruce, he said, I love what I hear. I think you have some really great stuff. He says, but let me ask you this: are you a good person? And I thought, wow. Well, I don't know what you're using as your measuring stick. I said, I have a wife who has put up with me for 44 years. And I said, that's a pretty rare thing these days. I said, but I'm very blessed with a saint of a wife. Monica is just amazing. I said, we've raised two wonderful boys that turned into young men. Are very proud of them. We've certainly steered clear of problems and issues, other than the little piddly stuff that all people have in their families. But I said, I think the answer I'd like to give you is just, why do I do this? Why am I doing this? I don't need to do this. I said, I don't need you to become a client. I said, first of all, unless we can find a significant value of additional value you're not getting from your planning, you shouldn't be a client. I said, but if we can do that and you be the judge of it, we'd like to have you as a client. But I said, the thing is, I've amassed security for myself, wealth. I've got, I think, the best clients on the planet. I've got all this knowledge. I have all these tools. And I said, if I just retire to a beach somewhere and sit on the beach till the day I die, I said, when they put me in the ground, they're going to put all that knowledge and all that information in the ground with me. And I said, I've reached a tipping point in my career where I said, I want to provide that to as many people as possible. I want to, that's why we do the show. The show is taken on a little bit of a different mission, but it's a way for me to reach the maximum amount of people and share the knowledge that we have. Even if you never come in for a plan or we never talk to you, if you've learned something from this program, then we've done our job, because that's the goal. Is knowledge is power. So one of the weird places that we kind of veer in a different direction is Social Security, because the financial industry has made this a marketing pitch, and I have a real hard spot with that one. Is, come on in, get your free Social Security report. We'll show you how to maximize your lifetime retirement benefits from Uncle Sam, and book an appointment and get in there, and then they want to sell you a product or whatever. The reality of Social Security, first of all, Social Security maximization is easy. I can do it in under 5 minutes, and I can show you how to get absolutely the maximum number of dimes out of Uncle Sam over your retirement lifetime. I just need the husband and wife to give me one simple piece of information, and I can guarantee them the highest Social Security payout. Just tell me the date that each of you are going to die. Tell me when you're going to die. Tell me when you're going to die. And they look at it like, I said, then other than that, it's nothing but a guesstimate. But I said, you should never make a decision about Social Security claiming. I said, individually, you shouldn't put on blinders and say, okay, how do I get the most shekels out of Social Security? It should be part of the overall income plan. It's basically, where are my sources of income? I can draw from my 401k nest egg. I can get Social Security. How does that fit in for that income you need? And what is the most tax efficient structure, withdrawal efficient structure. So it molds together. It should never, and I rarely use that word, but it should never be done singularly. If you have built a retirement plan based on I'm taking Social Security at this age because this report told me to and nothing else, you're missing the boat.
Well, everybody's situation is different. Everybody has different goals, a different time horizon. And like you said, regarding time horizon, nobody knows when they're going to die. If you did, it would just be simple math.
It'd be a lot easier to do
So
planning,
you
yes.
can pick a date, like I have longevity in my family. Let's run it till 95. Well, you can do that, and then you can find the exact sweet spot. If you live to 95, here's exactly when you can take Social Security to maximize it. Well, it's nice to know when that sweet spot would be, but no one knows the day or time, and therein lies the rub, as they say, or that's the crux of the biscuit, so to speak, because that is what you need to know. However, I think it is good to look at Social Security and try to maximize it. But again, like you admit, it's a guessing game. And so you don't want to hinge your retirement, your monthly, what you need each month based on and how long it's going to last based on a guess, do you?
No. And there's two parts to Social Security. One is the financial side of it. Two is the lifestyle side.
Sure.
Is, we have people that I will say this, I would say probably 50% or more of the people who come into our office, they have in their mind, here's how I'm going to take Social Security. After we've done a plan for them, they've changed that into a totally different solution. So that's big. That tells us there's significant value in considering that. But it's like, I mean, the conversation, I'm like, look, okay, if you wait till 70 to take Social Security, you're going to get this. Now, first of all, you missed all those years of income from 64 or 65, whatever you were going to take before. There's 5 or 6 years you've got to make up. You got to live past 82 or whatever to hit the
Yeah.
break even.
Yeah.
But I said, how healthy are you going to be at 70? Are you going to be able to go walk the Grand Canyon? Are you going to be able to go do these things at Yellowstone? Are you going to be able to go play that many rounds of golf? Can you do all those things? Or would those shekels in your pocket be of more value from a lifetime perspective, from a lifestyle perspective, earlier in your retirement? So, everything is not just hard financial with us. We're very much looking at that lifestyle cost and how to fund it, possibly take more income earlier and agree to do it for a number of years, 3 to 5 years, and then maybe reduce it back for a certain reason or what have you. So it is a more of a custom fit in the planning. But yeah, that's our take on it.
Yeah, I think that's huge. And obviously, Social Security is a big concern for a lot of people. You don't want to make a costly mistake with it. If
Yeah.
you do have longevity and you're planning on working a while longer, don't file at 62. I mean, there's some no-brainers that you can help people with. That's for sure, because people do make costly mistakes with Social Security. It happens. Now, the
And
next.
interesting, this is one that most people don't realize. There are do-overs. There are mulligans when it comes to Social Security sometimes.
Yeah.
So we've had people that are maybe they're 67 or 68, and they're like they look at it and go, man, I should have taken it a year ago. You can go back and say, I want to take my benefit as of here, and Social Security will send you a check. So there are expanded ideas, again, things you don't ever hear, and you're not gonna get it from the Social Security Administration. You call them, they're basically, "No, we're not here to design plans for you. We don't do that. You tell us what you want, and you come in and file it." So, you wanna have an advisor that's competent in that area as part of the overall
Yeah.
planning.
Oh, you certainly do, and I think that's really huge. Now, another conversation, and this is another big one. We're hitting the big ones. I mean, I think three of the biggest expenses people will have in retirement are taxes, probably maybe mortgage or rent, and then healthcare. And healthcare is a huge one, and for a lot of people, it may be number one. But the question a lot of people ask is, how will healthcare impact my retirement lifestyle? what do I need? Do I need to do anything extra to plan for it? Or do
You
I
know,
not need to
we
worry
have a
about it because I'll be on Medicare?
well, the first thing that people need to realize, and this is universal, no matter who you talk to, you need to put this one in the back of your mind and cement it in there with super glue, and that is this: healthcare in retirement is not just a cost, it is a wild card.
Mm,
It is something that even as we plan for it, there's just so many moving pieces. It's the type of insurance you have, the quality of care you can get from that insurance. We've been through that with Monica, had a stroke last year,
mm,
and certainly didn't plan for it,
mm.
and we saw a lot of pitfalls in the healthcare that was available in our local area, and we had to kind of go a different direction. But Medicare, there's lots of misconceptions. If I have a long-term care scenario, or is Medicare going to pick up the tab? Do I have to, I'm not allowed to give my money away, or I am allowed to give my money away, or how do I do this, or how do I do that? Prescription drugs. I have had more people that I've directed to Amazon, and this is not an advertisement, but I say, go to Amazon and look up the drug costs because they've got a pretty good competitive prescription program out there. So you can
Really?
kind
I
of
did not know that.
yeah, you put you basically, go to the search bar, put in, Amazon prescriptions, they
Huh.
take you to a questionnaire, you put your stuff in, yeah. Yeah, it's that's you gotta squeeze the most juice out of the orange, and that's what we
Right.
look for. Another one is no matter what medication you're taking, I don't care which one it is, look at the name on the medication and either go to their website and send them an email or call them and say, "Do you have any coupons? Do you have any special programs?" Because they do. And we have clients that have just been ecstatic about results they've seen in that arena. Like, I had no idea that I could do that. In life, you do not get what you deserve. You get what you negotiate.
Right.
Always remember that.
Yeah.
Always remember that. And
You first you
and
have
if
to
you
ask for it, and you
Yep,
have to talk about it. You have to ask about it and negotiate. I
yep.
try to teach my kids that. We'll be in the store and they're like, "Oh, they don't have this. They're all sold out. It was on sale. We really wanted to get this for mom." And I go, "Oh, let's grab this person." They're like, "Dad, no. Why would you don't talk to the manager?"
Yeah,
And I go, "Hey, here's a situation." And the manager comes back, "I found one the color you need and everything in the
yeah.
back." Yeah, we had one left it back there.
Or we located one across town or whatever,
Yeah. Yeah, and I'm like they're like, "Wow, that worked. Can't believe it." And I go, you're not gonna get what you don't ask for."
I
It's like
love
the
the way you did that.
sometimes
That was good. Tony's also an actor in his off hours, so, yeah.
right, right.
Uh,
But I mean, it's just like, "I can't believe that worked." It's like, yeah, it works. Ask. I ask
the
for things like,
value of social interaction.
yeah.
I mean, I wrestle with, dear God, I'm burned for this one, but I wrestle with this whole texting email thing. It's like, I mean, I tell Bruce and Chris, pick up the damn phone and call them.
Yeah.
And I'm like the dinosaur, and
Yeah.
I'm like, no, I
Yeah.
said, listen, people, you need to realize something. Yes, you're not 55 yet. You guys are young. Ugh. But I said the people that you will call, that's what they're expecting.
Right.
They're not as tied to their phone and, oh, beep beep beep, oh, I got a text. Oh, beep beep beep, I got an email. No, most of them, they're out in the golf cart somewhere. They didn't even take their phone because they don't want the wife calling them or whatever the case may be. But yeah, healthcare is not a joke. It's very serious. I mean, and it's additive. You've got your prescriptions plus your care, plus your primary care, plus specialist, plus deductibles, and there's just so many things. It is a giant wealth card, and it's a giant wild card. And the healthiest retirees, even if you say, "Well, I don't have a lot of health issues," you still need planning because it's going to be healthcare isn't something that is just necessarily following a strategic path. It's basically almost always a surprise. So it's something we want to be, and we also do stress testing for like long-term care scenarios. So once you have a plan, then we can feed in the different questions, and it's going to give us pretty much instant projections. Okay, what if we have an unforeseen $200,000 over a 2-year period long-term care, and it hits us at this age, 76? What's that going to look like? But you've got to have an elite wealth advisor that is comfortable with their tools, with their experience levels, with their resources to be able to do that for you. And you deserve that for your wealth. And if you saved $500,000 or more for your retirement, and again, we're not trying to be discriminatory, but that's really where this planning starts to
Yep.
really manifest itself in the form of significant additional value. Give us a call,
Yeah.
888-888-5601, or I encourage you, go to discoverunlock.com. If you want the best checklist of the conversations you should be having, discoverunlock.com is going to give you a free report just for answering a few very simple comparison questions, and still give you the opportunity for that 20-minute discovery call with one of our elite advisors.
Well, and I think that's great. It's a great offer for our listeners and viewers out there, Bruce. Now, the next big one, and I think this is huge, and this is where I think most people, maybe they don't even realize this is the problem, but this is the problem with retirement when it comes to their finances. And that is they've spent their whole life turning an income into savings. We've gotten good at that. We put away in our 401ks. We've saved 500,000, 750, $1 million in our retirement accounts. We know how to save, or whether it's 200,000, whatever you have money in a 401k or a work TSP, 403b, some type of retirement account. Hopefully you might also have an IRA or a Roth IRA, but those are big lumps.
Coffee can,
lump sums of money. You have a lump sum of money. Usually it's in a specialized tax designated account in stocks. Almost everyone I know has a 401k or a 403b or a TSP. It's all in the stock market. It's all in this retirement account. It all has some type of tax designation. How do I turn that lump sum into an income, and how do I know how long it'll last? How do you turn your savings into a reliable income that you know will be there every month? That, I think that's the trick of retirement, isn't it? I mean, you wouldn't probably have a job if that was if that was easy. I don't know if there wouldn't be as many. You'd probably still have a job because of your breadth and depth of knowledge, but a lot of so-called financial planners or investors wouldn't have a job. That's for sure.
Yeah. No, I mean, if you go back to your grandfather's retirement plan, he had a pension. There was no moving parts, so a
Right.
financial planner, and what was it based on? It wasn't based on a lump sum, it was based on income,
Yes.
because at the end of the day, that's the part that you're going to realize. That's what's going to define your lifestyle. So how do you take this lump sum and turn it into, what's the most viable path to turn it into income? And, so first of all, we want to be realistic about it. One of the biggest challenges in planning, and we have found a way to overcome this finally, because this has been one of my pet peeves for 25 years, is when you're having the discussion, you want to have the best data to generate your numbers. And the one question you ask people is, okay, can you get what's a good number for your monthly expenses in retirement, or your annual or quarterly expense? And you watch the super deer in the headlights look every time, because it's like, I don't know, I don't track that stuff, because we've got checkbooks, credit cards, more money than no. But the bottom line is, you've got to have a number.
Yeah.
And people, it's very hard to come up with that. So too many advisors just pick a number out of thin air, but you're basing your entire future on that thin air guesstimation. And I have a real hard spot with that. So we have now adapted to a new advanced technology we love. And it's called an income guardrail system. So it enables us to say, all right, you have X amount of dollars, and your income that will generate from your nest egg and your Social Security, we plug it in there, is this much a month, or this much a quarter, or this much a year. And in most cases now, we find that the retiree says, oh, I don't need that much. You're like, okay, but we need to know it can sustain that. That is the sustainable number. And then, because that's our baseline. Now, our goal in the plans that we build, and this is only in the last couple of years, is now when we build a plan for you, it's like our goal, one of the goals we build into the plan is, we would like to increase your income every 2 years. automatically build in an increase because things are going to cost more. You're going to need more. You're going to have unplanned expenses. That's retirement. We've seen it so many times. So they like that, and you say that if we do the risk correctly, so we're mitigating the downside problem. So we're not going to have downside adjustments in almost any case as far as income. But as the portfolio grows, we're going to have these trip points that says, "Oh, hey, time for a pay raise for John and Mary," and most people are like, "Wait a second, I've never heard that before. When did you? Where did that come from?" Well, this is I think there was a great comment from a client last week. They said, this whole idea of your elite wealth planning, your elite wealth management, um, you guys kind of start where everybody else ends. And I thought that was a real great assessment. I'm like,
Yeah.
yeah. I said, everybody
That's
else,
a compliment.
income, 4% rule, stop, boom, done, next. And we're kind of going, all right, time. Let's assess all that you have. Let's account for Social Security. Let's build the income guardrail, and it'll support this kind of income. And they're like, yeah, you guys took where they were. That's where you started, and then you build it on that. And that's the key to elite wealth strategies and working with an elite wealth advisor. So
Mhm.
yeah,
It's
that's the name of
important.
the game for income.
Yeah, exactly, because it's a 360. It turns it on its head. Instead of using that income and creating a savings, you're taking your savings and you've got to create an income. So that's a big one. Now, and it ties directly in. All these conversations do fit together and tie together in one way or another. And the next is, what if I live longer than I expect? People are living longer and longer. And this ties in with the number one fear of running out of money in retirement. What if I live longer than I expect? I mean, the
Yeah.
good news is we're living longer. The bad news is
We're
we're
living
living
longer.
longer. Yeah.
Yeah. You said about people, with Social Security, you said about knowing when you're going to die. We had a client recently, wonderful client, one of my very best clients ever. And his sister was a little older than him. His sister had died. And one day I had breakfast with him. We were talking, and he said, "I'm going to live to 109 months." And I said, "Okay. How do you come up with that?" He said, "Because he said, my sister and I had the same doctor. This is not a joke, by the way. My sister and I have the same doctor, and he told her she'd make it to 100. She lived to be 99 in 3 months." He said, "So I told him, listen, I'm going to live to 109 months because I want the 9 months you shorted my sister added on to mine, you know." And here's the crazy part. He lived to 110 months before he passed.
Wow.
Yeah, true story.
Wow. He
Phenomenal.
hit it
Great
pretty. We
story.
joke about being able
Yeah,
to guess your date, but that's pretty
that
close.
was an interesting, and mind you, this is a gentleman who had been through 4 different rounds of cancer treatments. I mean, there's just all these things like no way would this guy make 100, and he did it. It was, and I think there's a lot to be said for that power of positive thinking.
Yeah.
My dad always said, "I'm going to live forever." He made it to 93, and here's a
Wow.
guy that smoked, what the hell were they? Raleighs. My
Oof.
doctor clients say Raleighs. Oh yeah, they had no filters. We always said you got the Raleigh coupons that would help you buy the iron lung you're going to need. It's like, oh my God. So what if
Oh,
I live longer than I expect? First of all, we plan to 90. And we don't zero things out by 90, so you still got wealth left over. But what we find is, how do you best plan for a longer than expected lifetime? And the answer is by having a plan to maximize your lifetime wealth now. Because if you look at the graph of your current planning and you look at the graph of an elite wealth management plan that's now finding additional value in tax savings, finding additional value in reduced risk, keeping more of that money working for you, finding additional value in strong returns during good markets, and you add all of this stuff together, you find that you have an additional buffer that will get you through living longer than you expect. So we build that into the planning. If plan A shows I'm going to have $200,000 left over, plan B with 30% less risk, lower taxes shows I'm going to have $600,000 left over. There's a little bit of a cushion there to kind of get you through it.
yeah. Yeah. And I think we have time for one more conversation. I think we've talked about risk a bit. What about spouse and legacy? I mean, how is my spouse protected if I go first? I mean, women typically outlive men by 6 years. And you don't want to leave you want to make sure your wife or your spouse, if it happens to be the husband that outlives the wife, that happens too, but you don't want to leave your spouse in a bad situation or your family,
No,
right?
no. I mean, the answer is very simple: stress testing. We build that in, and then we have scenarios we plug in. We say, okay, if John were to predecease you at age 72 and you live to 90, not that 6-year thing you're talking about, what does it look like? And believe me, it's not that once we have the base plan built, it's not that hard to put these things in and illustrate them and show them. But the other thing is, how do you give the best opportunity to the spouse, to a surviving spouse? And the biggest one is tax planning, is having them, because they become a single taxpayer. So now their tax rate after the death of a spouse goes up. You're going to pay more taxes for a dollar withdrawn than you did before when you were married. And it's so unfair, especially women live longer. So who's stuck with the higher tax bill? They are. They typically lose an income in the form of one Social Security evaporates. They need to go now to the IRAs or the 401k, take more money out to replace that income they lost. And they got to take even more money out than before to pay taxes. We find that typically the tax total for a year after death of a spouse, in most cases, the taxes themselves go up about 30%.
Yikes.
That's
Because they're
again,
no longer married filing jointly and they don't get a tax break there.
right.
And a lot of people don't think about that. Plus, your bills don't get cut in half once your spouse dies. The bills that if you have a house note or you pay your electric bill or what have you, your property taxes aren't going to get cut in half just because there's only one of you now living there, right?
Yeah. So I mean, it is a very important thing. It should be part of we said these are the important conversations you need to have. I
Yeah.
mean, I know we're running a little short on time today. I mean, I'll round these last couple out, and that's, how do I reduce risk without sacrificing my lifestyle? So, you don't want a 30% drop in the market to crush your plan, and now all of a sudden you're not going to take those trips or play as much golf or whatever. And then
Right.
finally, what should it accomplish? Why do I have this nest egg? How do I get the most? So having these conversations and having them with somebody who's A, willing to listen, and B, willing to provide proactive input as opposed to a product solution is going to put you light years ahead by having a comprehensive plan. And that's what an elite wealth advisor can do for you from WealthCare.
That's great. So, Bruce, before we go, this has been a great conversation about conversations, and people need to have more conversations about their own personal situation. We did an overview, and you do a great job with that. But how can they get a hold of you or set up that consultation?
I'm a Big Bang Theory fan. You know
Oh,
that,
yeah.
right? You realize if Penny was watching this show, she'd say, "Oh my God, now they're jibber jabbering about jibber jabbering."
Right. Conversations
Yeah,
about
conversation about
conversations.
conversations. Give us a call. I'd love the chance to talk with you. 888-888-5601, or visit us at discoverunlock.com and get your checklist and make sure you're getting all the conversations with whoever you're working with, or even maybe your own self-assessment. But discoverunlock.com, schedule that 20-minute discovery call, or give us a call at 888-888-5601. And we'd love a chance to talk with you and see how we could help you unlock massive additional value for your retirement.
All right. Well, Bruce, great show today. A great topic. These hot retirement income conversations that are going to help determine how long your money will last in retirement, and figure it out. Get some numbers. Get a plan that will allow you to sleep well at night. Put those guardrails in place that Bruce and WealthCare have for you. I think that's great, Bruce. Listeners and viewers, thanks for tuning in. That does it for today's episode of Unlock Your Retirement with our host, the one and only Bruce Smith.
Take care, everybody.